Okay, so Deere reported quarterly financial results recently, and the stock price fell several percent. And when I looked at the quarter, it looked like a really good quarter in terms of performance. But I saw something and understood why that stock price fell as a result of what management said. So, in this video, I'm going to bring you the big picture items that I saw from Deere's latest quarter's financial results. I'm also going to update my recommendation for Deere stock. Going into the quarter, I had Deere stock rated as a buy, and so I'm going to update that recommendation by the end of the video. I'm going to let you know if I changed it or if it's still a buy. All right, so let's begin. So revenue jumped by 30% for Deere to $17.4 billion. Earnings per share increased by 42% to $9.65. These are remarkable results for Deere. This company is not a company that grows at these levels longer term. These are short term factors that are boosting Deere's prospects in the near term. So, this is what I meant by when I said the company had a relatively strong quarter, but the stock price fell. And I'm going to get to that, so stay with me here. Its production and precision agriculture segment saw sales increase by 53% to 7.8 billion. The company's forecasting 20% growth for 2023 with an operating profit margin expanding to 25%. That's up from 20%. So not only is Deere expecting robust growth in the segment, but that growth is coming even though the company is expanding profit margins, which is important because some companies sacrifice profit margins for growth, lowering prices to boost sales. That's not the case for Deere. The company is boosting sales while at the same time boosting profit margins due to several factors, including the one that Deere raised prices recently several times. Its construction and forestry segment saw sales increase by 23%. Deere is forecasting a slowdown to low single-digit growth for the industry. However, Deere is expecting 15% growth. So Deere is expecting a big market share increase in this segment, with the operating profit margin expanding to 18.5%, up from 16%. Again, solid growth for Deere in this segment. For 2023 overall, Deere is forecasting net income between 9.25 billion and 9.5 billion, with operating cash flow of 10.25 billion. That's why the stock price fell. Okay? Because if you compare that with 2022, Deere reported net income of 7.1 billion. So growing net income from 7.1 to 9.25 billion would be a growth rate that is much slower than what the company has grown for the first and second quarters. Right? In the second quarter, Deere increased its earnings per share by 42%. So if you're telling me net income is going to grow by much less than that for the whole year, then you're telling me that the third and fourth quarter are going to be considerably slower than the first and second quarter, right? By averages, that's how it must play out in order to come to the conclusion that overall 2023 net income will hit a certain point. So that's why the stock price fell even after a remarkably good quarter for Deere. Is the forecast for the rest of the year was bleak, to say the least, because if you compare it to what's happened so far in the first and second quarter, that doesn't look good. That doesn't look good, and it came as a surprise to me because in the first quarter, Deere was talking about how they had such a strong backlog of orders to deliver that they had customer demand well into the back half of this year. So I was a little surprised by this, and it could be management kind of tempering expectations a bit because this level of growth, remember, Deere is not, Deere doesn't grow revenue by more than mid-single digits in the long term. So growing revenue by 30% and earnings per share of 42%, that's way faster than what Deere is used to. And management might be trying to, bring it down to more moderate levels, manage the business more conservatively at the way they're used to managing the business, which I think is a prudent move as well. Companies got into a lot of trouble with the wildly fluctuating revenue and profit um, results during and after the pandemic. So trying to bring things down into more manageable rates is prudent in my opinion. So to answer the question and update my recommendation for Deere stock, I still rate Deere stock as a buy. I didn't see anything in this quarter that would make me change my recommendation. So I would say Deere stock is still an excellent dividend stock to buy right now. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.